Sydney property has had 9 downturns in the last 50 years, and every single one of them has ended. You're living through number 10 right now, and I'm going to tell you when this one is going to end as well. I'm a buyer's agent in Sydney, and I actually bought my first property back in the mid-90s. That will tell you how old I am. So yeah, I have seen a few bad markets in my lifetime, and while each dip and each downturn has had different driving forces, the way that everyone reacts is the same every time. There's fear, there's a bit of panic, everyone talks about a crash, but you know what? Property just rolls in phases and cycles, and you can actually calculate them if you know what to look for by going back and looking at what's happened previously. So first I want to give you 50 years of downturn data in 30 seconds. You can see just behind me there's a chart of all the downturns, and I'm happy to share that with you. Just send me a DM and I'll send it over. And the first big one back in the mid-70s, that was a 3-year downturn. Prices dropped more than 10%. It was due to inflation. There was another nasty 2-year downturn in the 80s thanks to 13% interest rates. There were those interest rates hiked after the newly floated Aussie dollar tanked and we had really, really nasty inflation. There was another big 2-year downturn, 1990 to 1991, when the Reserve pushed interest rates to 17%, the highest they've ever been in Australia, again to cool inflation. We also saw recessions in the 80s and in the 90s, thanks to these incredibly high interest rates. Then something changed from the 2000s. From the 2000s, it stopped being about inflation taming and recessions, and it started being about the availability of credit and about government regulation. So in 2008, we had the GFC. The reason for the GFC was everyone stopped lending money. No money, no loans, no property buying. It happened again in 2017, this time because there was a banking royal commission. So the money tap turned off specifically for investors from 2017, and we saw a pretty significant drop into 2018 and start of 2019. And then we saw another really severe drop from 2022 when government ratcheted up interest rates to unwind all of that COVID stimulus. And we actually saw property prices drop 14% in 10 months and then do a very abrupt about turn. And then, of course, that brings us to where we are today in 2026. Where are we now? Property prices are down in Sydney around 4% officially. I'm telling you it's higher than that. It feels to me like more like 5 to 6%. The Reserve, RBA, has lifted the cash rate 3 times. Thanks to the budget, negative gearing and capital gains. Tax concessions are out the window. So we've seen this big exodus of investors and no one's buying investment property at the moment, or very few. We're also seeing listings at a 5-year, 10% above their 5-year average. So we don't have a stock shortage. We've probably got a little bit of an abundance of stock. I'm not necessarily saying all of it's good right now, but that's certainly contributing as well. I think this downturn's partly caused by policy shock. It's partly caused by reduced borrowing capacity for investors specifically. It's partly caused by a couple of interest rate hikes, although we don't really have historically high interest. It's more the fear of interest rate hikes. There is also the issue of affordability. I mean, historically, what it costs to buy a house is costing more of a household's income than it ever has, and that does need to be rebalanced before we can see prices move north again. On the flip side, we don't have a recession. Our economy is reasonably healthy. We don't have a high unemployment. There's no fundamental collapse of the underlying demand because immigration's still running reasonably high. And there is no spike in supply. The cost to build is very, very high, and we aren't building enough. That's a fact. We all know that. So the supply-demand equation isn't really balanced either. So where is all of this leaving us, and where do I think we're headed? I think the market's going to turn somewhere between November this year and February, March next year. The past downturns that have had these sorts of causes generally run between 12 to 15 months, and I think we're going to see a repeat of that this time around. So I'm seeing the trough, the absolute bottom, that's the peak of despair, somewhere around probably October, November. Remember, we've got the December, January holidays. where the markets just completely go quiet and everyone goes away. So if we see a pickup in markets by early next year, we'll probably see the bottom of the trough by October, November this year, and that will probably be the absolute best buying window. If you're a buyer, you're thinking about buying, I'd be gearing up right now. It doesn't mean you need to rush out and buy something today, but certainly being prepared and having all of your ducks in a row to see the best buying opportunities probably from about July, August through to about October.